welcome back to the Dukascopy studios here in Geneva. Joining me once again is Allan Maksymec from Strategic Asset Management, and today we'll be discussing getting yields with low interest rates. So Allan, welcome back.
Yeah, thank you very much.
So tell me, with interest rates at almost every GA economy at an all-time low, where can investors get a decent yield?
Sure, it's pretty difficult. I mean, that is the problem that a lot of portfolio managers face. Investors were hoping for a rate rise and that we would see a normalization of interest rates. We didn't get that in September, we didn't get it in June. Now we're looking at December. So it just keeps getting pushed out, and in the meantime, investors have to find a yield somewhere. So, you know, basically your choices are dividend stocks, which actually are producing pretty decent dividends still. You've got things called MLPs, which are master limited partnerships in the United States. These are typically like pipeline companies, and they will basically reserve part of their profits to pay investors a dividend. And that's why a lot of investors invest in them. And because it's a very stable kind of business, quite often those dividends are quite secure. The problem is that they're also often linked to energy, which, you know, with energy prices falling the way they have in the United States, this is a bit of a strain on being able to pay dividends. Then you have preferred shares, which are a special class of shares, which often the dividends are more secure, they're slightly higher, but they're, at the end of the day, they're still equity, so they're not exactly bonds. Then you have bonds, then you have things like floating rate bonds, more exotic things like convertible bonds, and basically that's your universe of both sort of risk and safety, and along that continuum there is different amounts of yield that you can get, but it comes with risk, as always. And so, you know, basically that's what we're looking at, is those are your main choices.
So you've mentioned the choices there, so what are the kind of risks with these investments?
Right. So what we always like to say is that there's no free lunch. And, you know, basically with dividend stocks, what you're dealing with is volatility. Because they are equities at the end of the day, and in the month of August and September we've seen a lot more volatility than we have in many years. So that can unnerve investors that are used to a very stable kind of bond like portfolio with very stable yields. So that's unnerving, and also it's lower in the capital structure of these companies, so it's less secure. So in the case of a bankruptcy, you would be at sort of at the bottom of the pile in terms of being able to recover your funds. With the MLPs, as I was mentioning, they're typically energy related, pipeline related quite often, and they're supposedly less correlated to energy, but there is still a correlation to some degree, because we've seen the MLPs sell off maybe not as drastically as oil companies, but almost. So there's definitely a higher correlation than maybe what people have been led to believe in the past. So they've had a tough year. Preferred shares, the risk there is that if you're expecting more of an equity-like return, preferred shares act more like a bond because they pay out more in dividends. They act more like a bond than they would like a stock. The upside is that they're slightly more protected than typical common equity. Then you have, you know, obviously bonds, and there what we've seen is that the risk return of bonds isn't fantastic right now. Obviously everybody is invested in bonds and looking for any scrap of yield that they can get. So the credit spreads have tightened, meaning that lower credit companies are not paying a lot. Basically, there's almost no difference between treasuries and a triple B bond in terms of the yield that you get over time. It's very minimal spread between that, so you're not really being rewarded for the risk that you're taking. So then that leaves, you know, basically floating rate bonds, where you're looking at again, the credit spread is mainly what you're buying, because the bond floats with the interest rate, and that's part of the benefit. But you still are fully exposed to the credit risk of the company. So if the company has some difficulties, you'll see the floating rate bond decrease in value. And again, that can be unnerving for investors. Convertible bonds, the problem there, or maybe not the problem, but the risk, is that they're quite misunderstood because they have embedded options in them where the bond can be converted to stock at certain strike prices. Basically, if the stock rises to a certain level, you'll be converted from your bond into equity, which can be great if the company is doing fantastic. If the company is really not progressing and the share price isn't going up, typically you're just left with a bond. So those I guess are the main risks for those different types.
So those are the risks there. Are you seeing any trends in regards to yield investing as a result of these low interest rates?
Right. So luckily, as portfolio managers managing mainly balanced funds, we're able to go between equities and bonds. A typical bond investor, like a pension company, or a pension fund, or an insurance company, are really restricted mainly to bonds. As part of their mandate, they're not allowed to invest in riskier things. So they're really struggling. And so there is where we're looking at the trends. What are they doing? Because they're struggling to try and get yield to meet their obligations for pensions and for insurance payouts. They have to have that yield guaranteed. So now what we're seeing is a lot of unconstrained, what they call unconstrained bond funds. What we're seeing also is private equity, and also emerging, alternative asset class investments. Can be in emerging markets, but doesn't have to be. So basically they're kind of grasping at whatever they can find as well to produce yield. And the thing to be careful about with these unconstrained bond funds, it means basically that they can invest in almost any of those things that I've mentioned. So investors have to be a lot more savvy when they're doing their analysis, to be careful that they're comparing apples to apples, because with the unconstrained bond fund mandate, you're basically giving them free rein to invest in any of those things that I've mentioned, and each one of those has very different risk profiles attached to the investment. So a good manager can produce fantastic results, but there is also the risk that these they make some bad choices, and the bond fund becomes much riskier than anybody had imagined.
Absolutely. Well, Allan, thank you so much for coming in today and sharing your expertise with us. It was a pleasure to have you back.
Thank you so much. It's a pleasure to be here.
And thank you for watching. For all the latest Dukascopy updates and interviews, do keep clicking back. Goodbye for now.